Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Today, I want to dive into the world of tariffs, talk about what they are, their potential benefits and drawbacks, and how they can impact the stock market. I really want to take a closer look at what happened during the 2018 US-China trade war and how those played out in a real-world scenario. You can see this morning Dow futures are being slammed by 600 points after Trump hits Canada, Mexico, and China with tariffs. Although 600 points doesn't seem like a slamming to me, this seems like a relatively muted response to the potential of tariffs being implemented tomorrow, retaliatory tariffs being implemented by Mexico and Canada and China in reaction to what the US is doing, and what that might mean for the stock market, the average consumer, and the economy as a whole. So let's look at tariffs and really talk about what they are and dive into that before we talk about their impact on the United States economy and the stock market as a whole. So before we look at the math, and I also have a chart here to lay out the 2018-2019 US-China trade war, let's talk about what tariffs actually are. There's been talk about how tariffs are paid by the other country, they're paid by somebody else. They're paid by the person doing the importing, the person or the company doing the importing. So they are essentially paid to the country applying the tariff when the item is brought across the border. So in the scenario that exists today, when Canada has no tariff placed against it, you can go to Canada as an importer, buy an item for $100. If you want a 50% gross margin, in the case of $100, $100 gross margin, you can sell it for $200 and you're good to go. Now let's say we're looking at the world as it exists 2 days from now, assuming tariffs are implemented. Let's say, as an example, as a simple example, those tariffs range anywhere from 10% to 50% depending on the item. In the case of a 10% tariff, you go to Canada, you buy that item for $100. However, when you bring it across the border, you have to pay the United States government 10% of the item's cost as a tariff. So that's the tax being placed on imported goods. It helps the government raise money, generates revenue for the government, but it does make the input cost of that item more expensive. So in this case, a 10% tariff means you're paying $110 to bring that item into the United States. If you want to keep the same gross margin of $100, you have to charge $210, so a price bump of 5%. However, you are reducing your gross margin percentage in that case, and some businesses aren't willing to do that. If they want to keep the same percentage margin, meaning they want to keep 50% margin, they have to raise that price to $220 or a price increase of 10%. The same happens when the tariff is higher. At a 50% tariff, for example, the input cost is $150 because you pay $100 for the item. You pay $50 to the United States when the item comes across the border. Now, if you want to keep the gross margin at $100, you have to charge $250, leading to a 25% price increase. However, it's a gross margin of 40%. If you want to keep the same margin percentage, you have to charge $300 or a gross margin of 50%. So why would a country want to do this? Why would they want to implement tariffs knowing that prices are going to go up, as you can see here? Governments have a couple of incentives to implement tariffs. One obvious one is that this is a revenue generator for them. Tariffs are a source of income for governments because anytime you bring something across the border, you're paying the government a tax on that item. Now, that can be a good thing if they use that money well, if they pass that down in the form of tax cuts in the future. But remember that tariffs are very much a regressive tax. They impact the people making the least the most. If you're making $300,000 a year and your grocery bill goes up by 10%, is it a huge deal? Not really. If you're making $30,000 a year and your grocery bill goes up by 10%, is it a huge deal? Big time, because it's a big portion of your overall income going towards consumption, and those items are things you can't control for. Sure, taxes going down is great, but if it only impacts the people making the most and this negatively impacts the people making the least, is that a positive thing for the majority of the people? Probably not. Secondly, this is a way to protect and improve domestic industries. Again, you are often competing against foreign markets, which have lower costs of labor, more efficiencies, less whatever that allows them to produce items at a lower cost. As an example, let's say you use an item made in Mexico for $100 and compare it to a similar item made in America costing $120. Most people, most businesses, most importers are going to bring in that Mexican item for $100 because it costs less. Now, post tariffs, that item suddenly costs $125 unless that Mexican company lowers their prices, which sometimes they do. And now that domestic item is a lot more competitive. The negative thing that comes with that is that sometimes that can lead to reduced competition and distorted markets. If the Mexican item is now $125, what's stopping that American company from raising their price to $124, just lower than the Mexican item, but still affordable in relation to what else is out there? Secondly, maybe there's just no alternative. Maybe the item being made in Mexico for $100 might not have an alternative that's made domestically. That might mean we need to invest and start making that money domestically, or it might mean you're just forever paying a higher price based on the new tariffed fee that is being implemented across the board for Mexican items. So that's one positive, one negative that's in there. Obviously, when it comes to domestic production, that comes with national security. A lot of governments like making their own stuff in-house domestically, less reliance on imports from potential competitors, adversaries, etc. is always a good thing. Not saying that Canada or Mexico are adversaries, but certainly other countries may be in the future. So you're encouraging domestic production, protecting it, generating revenue. And another thing, a big thing, is that you're often using tariffs as a means of political leverage. This is a big thing for Donald Trump. The reason that can work is that Canada, Mexico are very dependent on exports to the US as a percentage of their GDP. For example, Canada's exports to the US are 19% of their overall GDP. Mexico's exports to the US are 26% of their overall GDP. So if suddenly we're placing tariffs on 19 to 25% of their GDP, and importers from the US are looking elsewhere for cheaper goods or looking domestically for cheaper goods, the economy of those countries, Canada and Mexico specifically, can go down to tank pretty quickly. And the US can use that as leverage to get concessions out of them. They can say, hey, listen, you guys are not looking at the border too closely and that's impacting America. Fix it. You guys are doing this, this, and that. Do it differently. And if they are so dependent on us, maybe, just maybe, they'll be willing to come to the negotiating table. Obviously, the negative of that is that if you're applying tariffs to them, it can lead to trade wars with them applying tariffs to us. However, when it comes to the trade balance here, U.S. exports to Canada / Mexico together make up 3.5% of our GDP. That means that we are a lot less reliant on exporting stuff to them that they can tariff than they are on exporting stuff to us than we can tariff, which puts the U.S. in a much better negotiating position. So another negative of tariffs is, again, you're reducing competition, you're distorting markets, you're essentially artificially inflating prices. If Mexico can sell something for $100, it's because they can do it more efficiently, they can do something better. Now you're telling them you basically have to sell it at $125, which means that if there's a domestic competitor selling something at $110, what's stopping them from just raising their prices to $120, $125 to compete more closely with Mexico and make more money? Because they can still probably get that item. You know, you're much more likely to get a domestic item for $120 than a foreign item for $125. So why not improve their margin? So you're sort of reducing competition, making the markets less efficient, and sort of distorting prices and misaligning economic efficiency in a way. And if this starts happening across the board, what's stopping other countries from just changing prices? Again, you may say, well, if Mexico is now $125, I can go to Ecuador, which doesn't have a tariff, and get this item for $105. But why wouldn't that company just raise their price to $115? To sort of just move things across the board, which leads to further inflation, leads to further inefficiency, and leads to a bunch of issues that wouldn't really exist in a free market. And again, on top of that, you have to remember that tariffs can happen multiple times. There could be situations where you're a business in the United States, you depend on an item that's made in Canada, so when that item comes over to you, there's a tariff applied to it. Then you have to send it to Mexico to get it produced in some other item, there's a tariff applied when that item transitions from the United States to Mexico. Then when you send it back from Mexico to the United States again, there's another tariff applied. So this could be a situation where it's not just a 5 to 10 to 15% increase in price. It could be a multiple of that because certain items are hit by tariffs multiple times. So that's the interesting thing about tariffs. It's never an easy situation. The idea here would be is that the United States is using this as a power play to get something out of these countries, that they're applying tariffs for a short period of time, that yes, prices are going to go up for a short period of time, but maybe, just maybe, Canada, Mexico, China, etc., will capitulate, give in to whatever the United States wants, and that'll be a benefit to the United States in the long run at the cost of some pain in the short run. However, if that doesn't happen, if this becomes a long, protracted trade war, then you sort of may see a repeat of what happened in 2018, 2019, but on a bigger scale. So it's important to sort of understand what that looked like. So let's take a look at that right now. This is a graph of the S&P 500, ticker SPY, specifically for 2017 through the early part of 2020. I wanted to look at what was driving price reactions during the USA-China trade war, and what did the stock market look like back then as a gauge of what I should at least be ready for if this trade war starts to become a longer term thing. Right now, we're still in the early innings of it. Yes, tariffs are likely to be implemented. It's unknown how long they will last. However, if they last a long period of time, like they did during the US-China trade war, then maybe, just maybe, this will give us some insight into what the stock market will look like. And as always, guys, this is not investment advice. Please do your own due diligence before making any investment decisions. I won't go into the details of all of these random tariffs, but end of day, it was like, hey, we're implementing tariffs. China counters, we counter. China counters, we counter. We implement them. There's an agreement to halt the implementation of a substantial bump. Then there's an agreement to have trade talks. Those trade talks sort of fall through. More tariffs are threatened. More trade talks are rekindled. More tariffs are implemented. And then finally, a phase one deal that suspends all tariffs is signed. But you can kind of see during this entire period, there's a ton of volatility here. Stocks move down quite a bit. This is bi-weekly period. So you're talking about, hey, a few weeks here, you're down 5%. Another week or two, you're up, maybe 3%. Down again. Up again quite a bit, despite the fact that tariffs are happening, that things are being talked about, that there's no negotiations around them stopping anytime soon. So you can kind of see that the market is volatile both in the negative direction and also in the positive direction, despite the fact that not a lot of positive news is happening. Tariffs actually kick in on substantial amount of Chinese imports with the promise that they're going to raise them in January 1. A big drop happens. An agreement is made to halt that, despite the fact that the stock market keeps falling, and then it starts recovering again. And one thing to keep in mind here, and I added a graph on the left side here to illustrate that, is that during this period of time, the Fed funds rate, the lower end of the Fed funds rate is illustrated here, was rising as well. So it's not just tariffs that are adding to market volatility. In December 2017, right around here, you went from a 1.25% low end to a 2.25% low end on December 2018, which is surprisingly enough, or I guess not surprisingly enough, when the stock market bottomed. And then the Fed funds rates started to lower again as concerns around inflation abated and the stock market started to rise. However, during this period of time, there was a lot of uncertainty. Inflation was moving in the wrong direction. Again, this wasn't 4 to 5% inflation like we saw a couple of years back. This was more in that like 2.5% range, but the Fed started to react a little bit. And that obviously had a bit of a negative impact on stocks, but also so did the tariffs. And you had this period of time where you were essentially in a flat to negative return on a lot of your shares for a year and a half if you were a buyer in the early parts of 2018 at this top here. And after that, you started to see some positive returns on a consistent basis. So what did this tell me? What does this teach me as I look at this around what might happen in the future. It teaches me to be ready for volatility. It teaches me that, hey, announcements might be made any given time. We're raising tariffs. We are removing tariffs. We've signed an agreement. We've not signed an agreement. We're adding tariffs to the UK. We're adding tariffs to the EU. All of that stuff could have negative pressure on the stock market if it's negative news, or very positive pressure on the stock market if it's positive news. So volatility, I think, is going to be the name of the game here, especially with how aggressively priced stocks are these days. When you look at the market in 2018, the PE ratios here were probably 15 to 20% lower than they are today. And you saw this sort of volatility. And this was obviously more pronounced on growth stocks than value stocks, but end of day, this was the volatility on the S&P 500. I think if tariffs are implemented tomorrow and they are here for the long term, then you can expect something like this. And again, I won't give you any advice on what to do about this, but I know that personally, I'm not really doing anything about it right now beyond what I've already done. I did a video about my plan for 2025, and I talked about how stocks seem expensive with the unknown around the new administration. I sold certain things off, and I'm probably sitting around 20% cash right now. To me, that is my maximum in my investment plan. My investment plan says I have to be 80% invested at all times, because if you miss the best 5 days in the market, you're missing a lot of return. So I want to make sure I don't do that. But I want to have cash on the side for when opportunities arise. And I think potentially within the next couple of months, year or so, there's going to be a lot of opportunities if these tariffs aren't a short-term thing. If Trump just says, hey, we're implementing tariffs, and a week down the line, Mexico and Canada capitulate because so much of their GDP is dependent on exports to the US, then probably not a big deal. However, if this is a longer term thing, if this impacts the pocketbooks of everyday Americans, eventually starts to flow down to the earnings of these companies that are expected to grow at a really massive clip, if their costs start going up and they can't pass that through on to the customer fully and gross margins are pressured, then the earnings might start to slow in terms of growth, or maybe even decline in certain industries. And with P ratios where they are, those are going to contract, and that'll mean some opportunities to buy at lower prices. And that wouldn't be a bad thing for me. I think long term, if you think about things very long term, eventually, hopefully some agreements are signed, some benefits to the United States come from this, because right now you're essentially threatening your best trade partners in Canada and Mexico and maybe even Europe. That's not a good look for the United States on the world stage. Sure, you can potentially bring a lot of this stuff in domestically, but that's going to take a long time to develop. And in the short term, that's going to be a lot of costs to American companies, to American consumers, and potentially negative impacts to the stock market. In the long term, could be very positive for sure. If you think about it that way, if agreements are signed that benefit the US, or if a lot of stuff gets onshored into the United States because of this being the new norm, then maybe, just maybe, the stock market will start to recover. But if you're looking at worldwide investing, short term might be painful, medium term might be painful, long term, as it usually is, stock prices tend to go up. Because if you just look at this, right? If you looked at this in a bubble in 2018, you probably said, man, this stock market sucks. It's never going to go up again. But you were buying at 250, at 275, even during the highs over here that eventually turned into lows, you're buying sub $300 for a share of the S&P 500. Now the SPY is trading at $600, so it would have to drop 50% to really get back to those prices. Earnings have grown quite a bit, but a lot of that has also come from multiple expansion. And maybe, just maybe, those multiples have to shrink a little bit. And if they do, maybe, just maybe, we'll get some interesting valuations. But end of day, nobody really knows. Sell all, buy all. To me, it's like you buy, you hold, and maybe with a small percentage of your cash, if your investment plan allows for it, you wait for good valuations to arise. And if they do, because of this, if suddenly certain stocks that I like are down 20 to 25% because margins are shrinking and valuations are compressing, then I'll certainly like to buy them at that price point versus the price point it's trading at today. But until then, and despite what's going on right now, every week, every other month, every other week, I'm buying more shares of certain stocks in certain accounts. I'm buying more shares of ETFs, and that's just going to continue to happen. Hopefully the economy stays strong. if there's a bit of a slowdown, obviously there's a risk of a recession, obviously a risk of losing your job. So keeping a couple of months of expenses in your bank account is probably the right idea. But other than that, I'm going to keep investing. I'm going to keep looking up for values. And when they arise, I'll hopefully make some videos about that. So what do you think about tariffs? What do you think about this plan? Did I explain them clearly enough? Am I wrong about something? What do you think about this graph? Do you see something like this happening again? A market where we're basically flat to negative for a year and a half, or even moving into the more negative direction, depending on how these tariffs play out. Leave a comment down below, like, subscribe, and if you're new to the channel, welcome, and thanks for watching. Bye.